Welcome to Private Financing by Marshall Reddick. My name is Patrick Prunty. I'll be your host. For the next 45 minutes to an hour, we'll be chatting about all of the unique and creative financing programs offered by Marshall Reddick that can help you reach your real estate goals faster. As I mentioned, my name is Patrick Prunty. My contact information is on the screen. I'd love to hear from you. I talk to investors every day about their unique situations and programs that the bank basically just can't handle, or situations in which you just don't have time to wait for the bank. So I encourage you to reach out. Again, I've talked to investors of all shapes and sizes with all types of unique individual programs, and I'd love to be able to help you with yours as well. Before we get started on topic with regard to the private financing offered by Marshall Reddick, just important to get a quick geographic update on Marshall Reddick, as well as a quick update on exactly what does Marshall Reddick do. So first and foremost, we don't just lend private money. We're also a functioning brokerage. We offer property management services, and that both of those services are in addition to our private lending division. Our corporate office is in Newport Beach, and that's the office that I work out of. But we also have an office in Los Angeles, two in Texas, one in Clarksville, which is right there on the border of Kentucky and Tennessee. So we also have a license and an operation on the Kentucky side, and our newest office in Southwest Florida, Cape Coral. So probably several more to come in a few different states over the next few years. As we continue to open up individual Marshall Reddick offices in large metropolitan areas around the country. Now, with regard to lending and what we do at Marshall Reddick, logistically, we are the same as any other lender that would be out there, bank or non-conforming or other. Right, and what I mean by that is we offer pre-approval letters to those folks who fit within the guidelines. We take a loan application from our borrowers on every transaction. We provide a loan estimate, right, breaking down the costs and fees and estimated cash needed to close. We take and process through your supporting documentation. We also, obviously deal with title and escrow and the communication with all third parties. So again, logistically speaking, very similar to any other type of lending institution that you would work with. The Marshall Reddick difference simply is, first and foremost, superior customer service. Right, you're always going to get somebody on the telephone in the lending department with Marshall Reddick, whether that be me or one of my amazing staff. In terms of speed, we, in my opinion, one of the fastest in the business. Right, and when that's needed, right? If we have more time, great, we'd always appreciate more. But as I'm going to show you some of our niche programs, if we need to close, within 10 days, we certainly can do that. We also take a collateral-based approach to all of our underwriting, where we're really focusing simply on the asset, right? The collateral, that property, as opposed to most lenders that are out there, especially those conforming lenders who are strapped to the Fannie Mae and Freddie Mac guidelines. Those folks are really focusing their underwriting on the borrower. So again, we have a strict collateral-based approach with little concern to the borrower and the background there. Specifically, one of the main points I wanted to hit on is we have a rate reduction, and this is the first time in the private lending history of Marshall Reddick, and we really have some super competitive rates. So from our permanent or rental program position, which a lot of folks use these for non-recourse loans inside of self-directed retirement accounts, or for other niche situations, perhaps you've got more than 10 conventionally or conforming financed properties, and you desire to buy an 11th, 12th, or so on, and then therefore you need private financing. So we've dipped under the 6% interest rate. Again, a very competitive rate from a private standpoint. And on our renovation or flip, or a lot of folks starting to use our short-term programs for BRRRR, those rates starting as low as 8%. Wait. I know there's some folks out there unfamiliar with private financing, and you're thinking, wait a minute, those are not great rates. The bank's offering substantially lower. What's all the hype about? Well, the bottom line here, folks, is that when financing real estate, literally go with the bank any chance that you can or whenever possible. There's just a lot of situations when it's not possible. I'll have some examples of those here shortly, but there's no reason that you wouldn't go with the bank if you can, if you have the time, if the property qualifies, right? And oftentimes the property will not qualify for that conforming type financing, or you simply don't have the time. Go private only when necessary, right? And again, as I mentioned, I'm going to go over some specific situations, but I've seen all of them. Most recently, I had a client executing a 1031 exchange, had already closed on the relinquished property, but that relinquished property was owned in the name of an LLC. So to effectively complete the 1031 exchange, they had to close on the new property, right? The purchase property at the back end of that 1031 exchange in the same name as the sale of the relinquished property, which means that had to close in the name of the LLC. And for those folks who have been in that position before, you know that conforming lenders do not make loans to LLCs. Therefore, Marshall Reddick to the rescue, we were able to, in a very short period of time, help her come up with a very reasonably priced, low interest rate rental property loan for her to be able to close and effectively complete that 1031 exchange. So again, go private only when necessary. So from a private and again, non-conforming standpoint, we're talking literally no doc, no nonsense. Marshall Reddick's very competitive in terms of rates and loan to value. So we don't have any ties to Fannie Mae or Freddie Mac or other government guidelines that are out there. And we specifically, in order to do so, make business or investment purpose loans only. Our private programs are suitable for and are specifically created by investors and for investors. And I'm one of those investors. After a nearly 2-decade career with Marshall Reddick, I've been involved in almost every type of transaction. So specifically and strictly, our loans are non-owner occupied. Also collateral based only, we talked about that, and strictly residential. So multifamily is okay. So there will be no industrial, there will be no strip mall, there will be no retail, right? No mixed use. So 1 to 4 family, still okay. And then again, small multifamily, so say up to 10 or maybe even 20 units for a specific program. So again, loan programs for all types of niche situations. Those that we do the most and that we will talk about specifically tonight are going to be the rental or permanent type loans, very long term, 15 and 30-year fixed options available. We'll also have a number of short-term programs, higher loan to value and higher interest, suitable for renovations or flips, or also those BRRR type situations where folks want to buy and renovate and go ahead and rent, refinance, and repeat. We also have some bridge or some transactional type funding. Again, these are very short term. This would be with no intent to renovate, right? And we even have a program that offers a deferred interest payments for a very short term, might be utilized by a wholesaler who was unable to, within the allotted period of time, sign the contract and therefore needed to go ahead and close on it. And even ground up new construction, I'd be surprised. There's so many entrepreneurs out there these days. And as a lot of the distressed inventory dried up over the past decade, those entrepreneurs are moving in with infill new construction as an alternative to flipping property. So take note that all the programs we'll talk about, they're all eligible for non-recourse status, right? But know that they are also specifically okay for purchase money loans, refinance, or cash out refinance. So any of those scenarios are okay and specifically eligible for any of the programs offered by Marshall Reddick. But please note, however, that our non-recourse status is offered only and strictly to self-directed retirement account borrowers. So anybody out there that is an individual or a corporation that's seeking non-recourse status, I can still make the loan to you, but unfortunately it will not be under a non-recourse status. So let's talk a little bit about our collateral-based approach and then the no nonsense that goes along with it. So again, these business or investment purpose loans are literally no doc. And by no doc, I mean there's no credit check, right? And it's not because we're lending to the subprime. That's simply not it. It's just credit is irrelevant in a collateral-based approach. We certainly do not verify income or employment, again, irrelevant. And we're not going to be asking for loads and loads of documentation. We're not looking for your schedule of real estate owned. We're not looking to review tax returns or the corresponding or associated documentation. And we're specifically looking at the asset. And that doesn't mean we throw all disregard to who the borrower is and what their experience level is, but we're just really more concerned with the collateral, the asset that's being used. So moving forward, what is relevant to the collateral-based lending, right? The borrower's cash position that's available for down payment and of course for reserves, the collateral value of the property, I just touched on that, and the borrower's equity. So if you're just buying it at a really amazing deal and you're walking into a big amount of equity, that's going to help. The collateral property cash flow, right? That's definitely important. And DSCR, which stands for the debt service coverage ratio. We definitely look at that with regard to our longer term financing. And usually it's not an issue at the low loan to values we're lending at in that rental program. But sometimes in higher property tax states, or in a situation where there's a homeowners association involved, and perhaps you're looking for that 15-year fixed with that shorter amortization period, the DSCR could be a problem. And if the DSCR is a problem, we're still willing to make the loan. You're just going to have to put a little bit more cash in and bring the loan to value down. Borrower background and experience, absolutely important. Whenever we get into a situation, we're doing the loan application, myself or one of my team members will be interviewing you, and we'll be talking about your experience, the type of properties that you have. If we're looking at a flip or a BRRRR type transaction, we'll be asking how many of those you've done in the past, and we might want to look at some of the past work that you've done. Pop quiz. I want to use my self-directed retirement account. I have 10 conventional or conforming mortgages. I'm self-employed. So the pop quiz here, if you haven't guessed already, is what are these situations? I need a low loan amount, perhaps under 50,000. I want to use my LLC or corporation. I need to close in 10 days. The property needs a ton of renovation. The bank is absolutely crazy, right? These are all situations, if you haven't guessed it already, when private financing is needed, right? And more and more private financing is playing a huge role in the financing of real estate these days as bank guidelines change and don't really suit the economic times that we're in. So let's dive in now to our loan programs. And as we do so, understand that you can always find these in their most up-to-date form right on the website, very clear and easy. Just head to marshallreddick.com/borrow, which I've got a screen clip here on the lower left of the screen, and you can easily see that you hover over borrow and go ahead and click on loan programs. That's going to get you into the situation where you can look at all of the rate sheets for each of the various type programs we offer. So now diving into the rental property loans, and I'm going to spend some time really breaking down that rate sheet. So anytime you get to the loan programs, you're going to want to go ahead and click download rate sheet as you see there on the right, and that's going to dive you into the nice, neat one page that's really going to give all the specifics that you need to know when evaluating which loan program you'd like to use and if it's workable in your particular situation. So first off is the term there on the left-hand side, and we offer varying terms, 5, 10, 15, or 30. Now notice next to it in the amortization, right? This is the period of time in which the loan is cast. So in the two top programs, the 5-year and the 10-year, you have a 30-year amortization, but the term of your loan is either only 5 or 10. So you get the luxury of a low monthly payment, but you end up with a very large balloon payment at the end of each term. Now, the balloon payment can be paid off by refinancing the debt with new debt. It could also be accomplished by selling the property, or obviously you can just go ahead and pay off the loan. But do be advised that those are good programs, but they do end up with that balloon payment at the end of the term. The latter two programs, the 15 and the 30, those are both fully amortized, so you could refer to them as fully fixed loans. far as rate and APR go, difference between the two, I get asked that quite often. The rate column is the actual note rate, the interest rate at which you will be paying. The APR factors in the loan costs, which down there in the bottom right, you can see the loan fees box. It amortizes in those loan fees over the life of the loan, right? And we are required as any lender to express the interest rate in APR, which stands for annual percentage rate form. As far as the payments go here in this column, note that these are based on a $100,000 loan amount, which is an easily divisible number to kind of help you on the fly understand what your monthly payment would look like. Regarding loan to values, notice that there's several different ones, and then I've got highlighted there at the bottom right the different types of loan types. Okay, so for purchase money will be our highest loan to value, and we will go to 65%. Now understand that's much lower than bank financing or conforming financing, which from an investor standpoint will likely go to 80% loan to value. But again, from a no doc or from a non-recourse standpoint, 65% is the highest in the industry. Whereas non-recourse financing for those few lenders who actually make those types of loans generally stop at 60% loan to value. So we're offering a little bit of an edge there on purchase money loan to value. In terms of a refinance, if you're just looking to replace the debt and no cash out, we will go to 60% loan to value. And lastly, if you are looking for cash out, whether you own the asset free and clear or you have very low debt on it, it's appreciated substantially, you are welcome to borrow and take cash out, but in a cash out situation, we will be limiting your loan to value to 50%. Now understand that these LTVs are going to be based on a third-party appraisal, and we use an appraisal management company just like every conforming lender out there, right? So third-party appraiser, and in the event the property appraises for more than the purchase price, the LTV will be based on the purchase price. And in the event the appraisal comes in a little bit lower than the purchase price, we will be basing the LTV on the appraisal if you choose to stay into the transaction. Speed, very, very important, right? 21 days is what we've been hitting lately, but a lot of that hinges on the appraisal. And appraisals have been somewhat of a challenge. Less appraisers in the market right now and a lot of real estate transactions happening. But we haven't seen one go more than 30 days. And so again, very competitive, even in this case, when it comes to conforming lenders, which in my opinion, and from my experience, I've been through several conforming loans. The process is very painful and oftentimes takes substantially more than 30 days, perhaps 45 or even 60. Again, painful process for you as the borrower, even more painful for the seller. With regard to the loan fees, very straightforward pricing, right? And very competitive pricing. So we're going to have that 2-point loan fee along with the other fees you can see here below. But I do want to point out when it comes to the origination fee, there is a minimum. So the break even on the 2% is a loan amount of $87,500. If you borrow less than $87,500, you will be paying the minimum of $1,750. Whereas if you borrow more than $87,500, you will be paying 2% of the loan amount. With regard to the loan servicing, generally speaking, in the lending or mortgage space, loan servicing is a lender paid cost. From a private standpoint, with Marshall Reddick, we shift the surplus or the cost of that loan servicing to the borrower for loan amounts under $75,000. So do know that if you're coming to borrow one of those really low loan amounts, 35, which would be our minimum, or even 50, all the way up to 75,000, you will have that $20 per month surcharge added to your principal and interest payment. I'd like to take a moment now to pause and mention a lot of folks are asking about escrow accounts or impound accounts. So generally speaking, we do not do those. You will be responsible for paying your tax bill annually or biannually, whatever the county requires, and also your insurance bill from an annual or sometimes even a monthly or periodic standpoint. You will pay taxes and insurance or HOA directly. We will not impound those unless you specifically would like to. And if you would like to, realize that that loan servicing cost will increase from 20 per month to 40 per month. Now, that may not be a big deal for much larger loan amounts, but $20 or $40 per month can stack up for smaller loan amounts. With regard to terms and requirements, specifically wanted to point out the bullet point with the monthly payment being less than 75% of market rent. I write it out in this capacity as opposed to presenting it in a percentage rate, which would be the DSCR, or the debt service coverage ratio. It's one and the same, right? It's just easier, I think, for folks to look at it as a percentage of market rent. So in this case, we will be doing an independent analysis on market rent, which might not be what current rent on the property is. I might also add that it's not a requirement that the property be rented. It is a requirement, however, that your maximum monthly payment be equal or less to 75% of market rent. So again, if we do that independent analysis and we believe that market rent on the asset that you're buying and borrowing against is going to be $1,000 per month, your maximum allowable payment will be $750 a month. And we simply start by looking at what the annual taxes are, what are the annual insurance, is there a homeowners association, and what does that annual cost look like? We then break those down into monthly expenses, and then we factor in the principal and interest payments and the cumulative total of all of those items. So your total monthly payment must be 75% or less than market rent. Keep in mind the 2-year interest guarantee. We also get a lot of questions about that. I'm going to break that down on the next slide in a very easy to understand capacity. So now I'm looking at an amortization schedule, a payment and an amortization schedule. And specifically, this program is our 5-year balloon, which is our lowest interest rate program at 5.95%. And I'm going to point you to the 24-month, which is the 2-year interest guarantee. Then I'm going to point you to your cumulative interest column there on the right. So you can see as the months go down, your payment doesn't change, but the percentage or the ratio of interest and principal is changing every month. Your loan balance is going down and your cumulative interest is going up. So simply put, the interest guarantee is the cumulative amount of interest paid over 24 months at the terms of the desired loan. As long as you pay that amount of interest, there is no other prepayment penalty associated with the rental loans. Okay, so you got to look at this from a perspective of, hey, I'm going to borrow this money and I'm going to make the regularly scheduled monthly payment for 24 months, and thereafter I can pay off at any time with no penalty. On the other hand, if for some reason you desire or need to sell, say at month 12, well, at month 12 in this particular scenario, you've only paid $8,000 roughly in interest cumulatively, and if you had to pay off at that time, that would translate into a pretty severe or painful interest guarantee, which would end up being the difference between the almost $16,000 number, take away the amount of interest you'd paid to date, roughly $8,000, and you'd end up with almost an $8,000 prepayment penalty. So keep in mind what that interest guarantee means. I'd also like to point out here the balloon payment. We talked about on our terms the 5 and 10-year balloon and what that looks like. So the original amount of this loan in this scenario was $135,250. And after 60 months worth of payments at $806 and change, the principal has only been paid down a very little amount, less than $10,000, which means that at the end of the term, month 60, should you still have this loan, you haven't refinanced or sold or paid off, you will end up with a balloon payment. And that balloon payment, if you've made the regularly scheduled monthly payments, will end up at $126,584.55. So you can see down there at the end, and I haven't given you the entire amortization schedule. I've cropped it there between month 24 and then jumping to month 50 through 60. At the end of this term, you will end up with that large balloon payment. So just be aware of that with regard to our rental programs. Okay, moving along to the renovation loans, and there's been a lot of interest in these. Flipping and BRRRR has become very popular over the past decade, and we've certainly morphed and changed with that popularity and been able to offer some really unique and creative programs to suit all types of investors. So again, looking at this renovation rate card or rate sheet, we're talking term. So these are all extremely or ultra short term with a maximum period for the loan of 12 months. You end up with a balloon period for the remaining principal balance at that time, which we're talking about interest only. Your payments in this type of situation will be interest only and not amortized. So at the end of the period, the balloon payment will be equal to the initial loan amount unless there was any prepayments of principal made during the term. With regard to the APR and the rate, again, comparing the two, the APR simply includes the loan fees as a percentage along with the rate to come up with a true cost of the capital. With regard to the payment, once again, we're talking about based on a $100,000 loan amount. You can easily and quickly use that as a divisible factor depending on what loan amount you are targeting to be able to understand what your monthly payment would look like. Keep in mind the speed in which these programs can be funded, right? Oftentimes I have done them less than 10 days. It's a little stressful for all parties, but at the end of the day, usually you will not be waiting on Marshall Reddick to fund the deal. If there is a delay, that will be on the title or escrow side, or perhaps it will be on the side of your insurance agent or somebody else, right? But we are very quick, and we're able to do that again with our collateral-based approach, where we don't have to just ask for loads of documentation and calculate debt to income ratios and all of those different things that conforming lenders are subject to. And again, why are conforming lenders subject to that? Simply put, they are abiding by the Fannie Mae and Freddie Mac guidelines, those governmental guidelines that are put out there that they must conform to so that they can sell those loans to those quasi-government entities. Marshall Reddick or its capital partners aren't selling these loans, right? So we can make loans at any terms that we choose. With regard to the renovation loans, there is no appraisal required, right? And this is one of the reasons that allows us to close these loans so quickly. What we do instead is we have an underwriting team in the Newport Beach office, and I will assign an analyst from that underwriting team who will be charged with formulating their opinion of after renovation value, right? And that will be based on a number of different metrics, certainly the scope of work, what type of renovation you plan to do, the lot size, the lot location, the school district. Again, a number of different metrics go into that underwriting, and we'll call that a CMA or a BPO, if you will, but no appraisal required. Note here, there is an interest guarantee, but it's much shorter, obviously, with only a 12-month term. So we have a 3-month interest guarantee, right? So this is discouraging those wholesalers who perhaps might use one of these high LTV loans to close on a transaction and then sell it off in a matter of days. The amount of interest paid would be very little. So you're welcome to pay off the loan at any time, but understand, say if you pay off at month 2, you'll end up with a 1-month prepayment penalty. Once you've passed the 3 months, then you're certainly just paying interest on a daily basis, simple interest. You obviously are not paying 12 months worth of interest. It's only a daily calculation of simple interest. Keep in mind, however, on a lot of these programs, there is going to be a renovation hold, and I'm going to specifically talk about that. But unfortunately, like a bank or in a credit line or HELOC type of situation, you will pay interest in these programs on the full amount of the loan, even though you might not have the benefit or the cash in hand for the full amount of the loan. And unfortunately, from a private lending institution, we have no choice on that. Just keep that in mind. Regarding the loan to values, this is probably where I get most of my questions when it comes to the renovation loans. So I'm going to actually and specifically break down a couple of different scenarios for each of those. And once you get the hang of it, it's actually really easy to understand, but I understand when just staring at the rate sheet, they could be confusing. So keep in mind with any of these 3 loan programs offered, the maximum allowable loan is going to be 70% of underwriter opinion of after repair value. Now, also that goes into this loan to value analysis is the requirements for new borrowers. So I want you to specifically pay attention to the bottom 3 bullet points, which is going to be a required escrow deposit taken from the borrower at close of escrow. And it increases as the loan to value increases and helps us kind of mitigate our risks and ensure that the borrower has sufficient cash to finish the transaction. Again, I'm going to break down some individual scenarios here, but just keep in mind that 25, 50, and 100% requirement for each of program 1, 2, and 3. And so for the sake of this exercise, program 1 is the 8% first line item, program 2 is the 9% second line item, and program 3 is the 12% third line item. And so after close of escrow, you will be required to end up with that percentage of your total renovation budget in a third-party escrow account. All right, so diving into our scenarios for program 1, which is going to be the 70% of acquisition and 8% interest. And note for all the scenarios I'm going to be walking you through, I'm going to be using the exact same numbers, which is an acquisition price of $100,000 and a renovation budget of $40,000. In this particular situation, hypothetically, the borrower and the underwriter from my team have determined that the after renovation value is $200,000. So in this situation, the loan amount would end up being $70,000, which is 70% loan to acquisition and ends up being 35% loan to after renovation value. That's $70,000 at 8%. Divided by 12 months ends up with a $467 per month payment. And note that I have rounded that payment up to the nearest dollar. We end up with a down payment in this situation of $30,000. Closing costs are estimated around $3,000, and that estimate does include the loan fees paid to Marshall Reddick, as well as the title and escrow third-party costs. And then again, keep in mind, in this situation, you have a 25% of your total renovation budget escrow contribution, right? So that $10,000 is 25% of your $40,000 renovation budget. So in addition to your down payment and closing costs, you will need to bring in an additional $10,000 and place that in an escrow account. Keep in mind, you get to use that $10,000 on the renovation, and we will let you draw down on it once the renovation of the project has been completed up to 50%. So in this situation, the total cash required to close on a transaction like this is going to be your 30 down, your 3,000 approximate closing costs, and your $10,000 escrow initial contribution at close of escrow. Taking that a step further, your total cash to complete the entire transaction is going to be about $73,000. And this just includes the remaining amount of the renovation, because in this situation, you're only borrowing a percentage of the acquisition, 70%, which means that you not only have 30% down, but you will cover 100% of the renovation out of pocket in order to get our lowest interest rate program at 8%. So again, about $73,000 to do this transaction, whether this is a flip or a rental property that's being purchased in order to be RRRR. Moving on to program number 2 and in a scenario or example thereof, right? This is the 95% of acquisition, which you're going to pay a little bit more. It's a little bit more expensive at 9%. But again, our same $100,000 acquisition and our $40,000 renovation budget with our underwriter and borrower agreeing on the after renovation value at $200,000. Loan amount in this case, $95,000, of course, 95% loan to acquisition. Interest payment, 9% on $95,000, $713 per month, again, rounded up to the nearest dollar. And we end up with a loan to after renovation value of 48%. That is also rounded up to the nearest percent. Down payment wise, substantially lower, right? Only $5,000 down. Borrowing a little bit more, so our closing costs have increased a little bit. And again, the closing costs include the loan fees paid to Marshall Reddick along with all other third-party closing costs. Renovation and escrow contribution in this situation, again, going back to that rate sheet in program 2 with the higher loan to value, we're going to require you to bring $20,000 of the $40,000, which is 50% of your renovation budget, to the closing table and deposit it in a third-party escrow account. Once again, you can utilize those funds on the renovation, and we're going to allow you to draw down on those amounts at project completion of 50% and at 100% when the project's been all wrapped up. Regarding cash to close, brought down substantially, right? In the prior one, I believe it was $43,000. If you wanted the lowest interest rate, in this case, you're going to pay a little bit more risk to the lender, but substantially less cash to close initially on the transaction. Your $5,000 down, $3,500 closing, and your $25,000 renovation contribution. Total cash to complete this, again, just inclusive of the entire renovation budget. You'll have your $5,000 down plus your $35,000 closing, no change there, and then your total renovation budget of $40,000. Keep in mind with the cash to complete, this does not include the monthly interest payments that you will need to carry during the transaction. The average period of time that these loans are out is about 6 months. So 6 months at $713 per month. Make sure you've got sufficient reserves in order to be able to make that monthly interest payment. Moving along to example for program 3, probably my most popular program, and this is really suited for folks who are doing volume. I have a lot of borrowers who are doing 3, 5, or even 10 transactions at a single time. These are very sophisticated professional businesses. In any case, they need to borrow the maximum leverage, and as you recall from the rate sheet, the maximum leverage or loan amount will be 70% of after renovation value. Anytime the loan amount exceeds the acquisition price, which is the case in this program, the interest rate will be the most expensive at 12%. Using the same $100,000 acquisition price and the $40,000 renovation budget, and once again, our underwriter and borrower agreeing on a $200,000 after renovation value. In this case, we're talking about a loan amount of $140,000. Where did that number come from? Well, that is 70% of after renovation value, right? And your monthly payment, 12% on $140,000 divided by 12 months in a year, we're looking at $1,400 per month. So your down payment, no down payment, okay? Your closing costs have gone up because your loan amount has gone up. And of course, the $4,750 is inclusive of the loan fees and the third-party title and escrow expenses. In this situation, keep in mind that you do still have a escrow contribution required. If you went back to that rate sheet, you'd notice that for program 3, we require a minimum escrow contribution, 10% of the acquisition or the purchase price. So in this case, $100,000 purchase price or acquisition cost, 10% of that is $10,000. Okay, now you're going to get these funds back here, as I've shown at the bottom, when the renovation is 100% complete and get some relief after you've exhausted the escrow hold, or you can simply borrow $10,000 less. And the reason I bring that up is because if you're borrowing $140,000 and you're putting in $10,000 out of the gates, the initial release on the $140,000 loan will be $90,000. So in that case, the difference between your $140,000 loan and your $90,000 initial loan release is $50,000, which is $10,000 more than your renovation budget. So if you prefer to simply keep your $10,000 in the game for the entire project, then your choice. Go ahead and borrow $130,000 instead. But do know that a lot of folks really prefer, after the renovation has been completed, to get that relief, that $10,000 back, right? So that they can utilize that on other projects, perhaps during the period of the time that the property is listed for the sale, in the event of flip, or in the period of time during the refinance if the borrower intends to hold that property after the short-term loan. So total cash to close in this situation, again, continuing the trend downwards, in this case, $14,750, which is just your initial $10,000 escrow contribution and your closing costs. Total cash to complete this transaction, $24,750. So a very moderate number to be able to enter into this unique and creative type situation. Perhaps you're flipping the property, perhaps you're executing your BRRR, and you're going to be holding it as a rental property, refinancing then at the fact based on your after renovation, and you're hopeful of potentially appraised value at 200 to help you get in with less than down than if you were buying the property straight up for 200,000. And of course, in that situation, building in your equity. So the cash to close, or cash to complete in this transaction is simply going to be your closing costs plus your 10,000 initial contribution. And here is another important thing to understand: your $10,000 renovation for phase one. So what I mean by that, and you'll revert back to the rate card to be able to see this, all of the renovation draws will be done in a reimbursement style fashion, which means that after you close, right, you can see the cash to close in this hypothetical scenario, 14,750, you will then have to extend additional capital from your pocket to complete phase one of the renovation. When phase one of the renovation is complete, you will send me photographic and video evidence that those items we agreed upon at closing in terms of the renovation have been completed. And when clearly they have been completed, then we will agree to release from the escrow hold that agreed upon release of phase one to help you get some relief and move into phase two. We repeat that same process throughout the entire transaction. You'll use the release from phase one to complete phase two. When phase two is completed, you can request and again draw down on the remaining escrow funds, and so on and so forth until the escrow hold has been exhausted and the renovation has been complete 100%. Now, let's take another interesting scenario. Same numbers as before with the 12% program, but in this case, we had a difference in between borrower opinion of after renovation value and underwriter opinion of after renovation value. So the borrower in this particular case still thinks that it's 200,000. They're super confident about that. But for some reason, there's some issue that my analyst from the underwriting team has, and they placed an after renovation value of 180,000. In this case, the underwriter or the analyst's after renovation value rides, and we end up with a $126,000 loan amount maximum, which is 70% of their opinion of after renovation value at 180,000. So our interest payment, 12% on 126,000, we're looking at $1,260 per month. Now breaking it down, again, no down payment required. Your closing costs dropped a little bit compared to the prior scenario where the loan amount was 140, because now you're only able to borrow a maximum of 126,000. And in this scenario, be advised, you have a little bit higher escrow contribution, right? You've got your 10% of the acquisition, and the acquisition cost at 100,000 didn't change, but at 126, right, you've got a $4,000 escrow shortage to close with the full $40,000 renovation budget on account. All right, so how did that work? Remember that we're going to have an initial loan release equal to 90% of the acquisition. So 90% of the acquisition is 90,000, right? The other way to look at that is simply 10% less of the acquisition at 100,000, you get the same 90,000. So if we take our total loan amount at 126,000, subtract 90,000 initial loan release, we end up with $36,000 in escrow. And you need, per the guidelines for program 3, the full renovation budget at 40,000. So there's a $4,000 renovation escrow shortage. You'll need to bring that 4,000 to the table in order to close the loan. So in this situation, the total cash to close, closing costs, your 10% initial contribution, and your $4,000 escrow shortage. So $18,450 to close in this scenario. Total cash to complete this transaction at $28,450, again, is going to be inclusive of those in the cash to close. So your closing costs, your initial contribution, your $4,000 escrow shortage, and the $10,000, which is the estimate for dollars out of pocket to complete phase one. Now that 10,000 number is a variable number, and you get to choose that number as long as it's reasonable. I chose 10,000 because it's simply 1/4 of the renovation budget at 40,000. And most folks like at least 4 draws, and they do so at equal increments, 25%, 50%, 75%, and 100% renovation completion. So just using easy numbers is how I arrived at that 10,000, and ultimately how I came to the numbers of how much cash you need to complete this entire project. Remember, keep in mind that that does not include your $12.60 per month interest cost. So make sure that you've got sufficient reserves to be able to service that debt. Remember, in the same concept as we showed in the last scenario, the reimbursement style draws. So you must get renovation phase 1 completed before you can draw down on the $40,000 renovation budget sitting in that third-party escrow account. Now, keep in mind, I understand, and Marshall Reddick understands the need for speed. Those renovation draws are processed very quickly as long as you provide good, sufficient photographic and video evidence. Do we send out a third-party inspector? No, we do not. If something looks fishy, we reserve the right to do so. So again, just make sure that you do all of the items that we agreed upon in terms of each of those phases of the rehab, and make sure that your photos and your video clearly show what has been done. All right, moving on to the bridge loan. So again, these are scenarios where you will have no intent to renovate the property, transactional type funding, if you will. So on the bridge loans, we have 2 programs available. And I'm going to spend a little less time on these. These are used a lot less, but one of the unique and interesting things about the bridge program is that we offer a deferred interest program, but it's in only a 3-month term, so very, very short, which means that you need to execute on paying off that loan or selling off or doing something to where you can pay off that loan very quickly. And a scenario where this might be the case is like, you're working with a conventional lender and a conforming lender, and they just dragging their feet and they can't get the loan closed. It happens all the time, but your seller's ready to simply pull out of the transaction because you can't close. Call on Marshall Reddick, right? We'll do a 90% LTV loan here for purchase money, right? 10% down, and then you can give your conforming lender 3 additional months time to refinance the property as opposed to a purchase money loan. One of the main differences in the bridge programs versus the renovation programs is that there's no interest guarantee. And a lot of times folks think that they're going to move those properties and have the loan paid off inside of that 3 months. And if that's the case, no problem. We have those programs available for you. Also keep in mind that the minimum down payment is $10,000, which, could end up from a LTV standpoint being higher than your 85 or 90% purchase money loan to values here on the screen. That's just going to be the case for lower purchase prices. If you are borrowing more than $100,000, you're going to have no problem, and that $10,000 minimum is already going to be met. There is a third-party appraisal required. There are certain niche scenarios in extreme low loan to value where we reserve the right to waive that third-party appraisal, but at the end of the day, we do desire to have one, which is why the timing is going to be a little bit longer here. On benefits, you're looking at 14 to 21 days. Otherwise, it would literally be 5 to 10 days if no appraisal was required, and we do that often for extreme low LTVs, 50% or less. With regard to the loan types, again, know that there are several different scenarios and different loan to values for purchase, refinance, or cash out refinance. Lastly, we'll talk about our new construction programs. And again, these are very cool. Work with a few spec home builders, some entrepreneurial prior flippers who are doing that infill new construction, and these have worked very well. A lot of times on these, we're not going to want to make that first loan to you if this is your first stab at new construction, unless you've got a third-party builder that you've hired to do so. You operating as the GC, there's just a lot of risk there, and we're most likely going to decline to do it if this is your first rodeo. We realize here that there is no appraisal requirement. That's key. Also understand that you will need to own the land free and clear. Consider that your equity, consider that your down payment for the high loan to values that we're willing to lend at. Also keep in mind, same as on my renovation programs, and definitely in a new construction situation, there will be construction draws. but you will pay interest on the full amount of the loan, even though you're not benefiting from the full amount of the loan from day one. So you need to make sure in a new construction situation that you've got your permits ready to go, that you're all dialed in, so that you're expediting your build time and your draws are coming quicker. You certainly wouldn't want to be in a situation where, you know, you went 6 or 7 or 8 months trying to figure things out and you're paying interest at either 9 or 12% on the full loan amount, even though you're not benefiting from it. As far as the loan to values go, right, we base those on the construction cost. And in the bottom left box there, keep in mind our maximum loan amount in either situation is going to be 75% of underwriter or analyst opinion of after construction value. So usually that's no problem, but moving into the top right, you're going to notice that we will lend at 9% up to 70% of the construction cost. In this situation, you will bring the balance or 30% of the construction cost. If you want to borrow all of it, no problem. 100% loan to construction cost, but that's going to cost you more money at 12% interest. Number of different scenarios to go over. Happy to talk with you guys about them specifically, but with the new construction, do know that reimbursement style draws are also required. So after we close, you will need to, out of your own pocket, move the construction and complete phase one. Oftentimes phase one is the foundation, pouring of the slab, building out of the basement, so on and so forth. After you complete phase one, you can start drawing down on the escrow hold and so on and so forth, just as I described in our renovation programs. All right, that concludes our breakdown of the 4 different types of programs we offer. Next, we're going to talk briefly about our loan application, which is all done online. This is a screen clip from our homepage again. If you hover over borrow and you click on loan application, you will end at this screen. And here you very easily just go ahead and click on private financing, and that will dive you into a questionnaire, right? 4 or 5 questions that you will answer before that dumps you into your loan application. This can literally be done in 10 to 15 minutes. We ask for very little information. It's nothing like the standard 1003 that you'll get from a bank that takes forever to complete. Once this is completed, an analyst from my team or myself will reach out to you for a documentation request. But know that if you run into any trouble or if you have any questions about this, just pick up the phone, right? Myself or someone from my team is always going to be available to answer questions on the fly. And we do really work in a 24/7 capacity. Residential real estate a lot of times is done late in the evenings or on the weekend. So don't hesitate to call if you have questions when it comes to the loan application. Lastly, I'm going to dive us into some frequently asked questions. And we'll start with, how do I obtain or request or obtain a pre-approval letter to submit with my offer? Very key, right? You need that quickly. So no problem, we're happy to do that. And no, you don't have to fill out a loan application in order to get the pre-approval letter. Again, our application is really revolves around the property, and you may not have a property, and those that are making offers know how competitive it is. So no problem. If you will need the following in the event you need a pre-approval letter. Right, so a copy of your driver's license or passport, some form of ID. We're also going to need your entity documents if you're borrowing in the name of an entity. We make loans to LLCs, corporations, trusts, you name it, self-directed retirement accounts, solo 401ks, right? If you're going to be buying in one of those entities, we'll need those documents. So for example, if you're using an LLC, articles, operating agreement, and we'll of course then going to need your IRS SS4, right? That's the document that the IRS gave you when they assigned your tax identification number. If you don't have that, no problem. You can complete, sign, and return Form W-9, request for taxpayer identification. In addition, we're going to need your most recent month full bank statement. If you're borrowing in the name of the LLC, I absolutely need to see a bank statement in the name of the LLC. Do not send me a personal statement. If there's no funds in the LLC bank account, that's okay. Right, but what I'm looking for is to see that you're doing business correctly and that you have a bank account open in the name of the entity in which you choose to borrow. Moving along, we have what type of loan it is that you're looking for: short-term, long-term, renovation, bridge. We customize our pre-approval letters to the type of loan. Additionally, we're going to need to know the subject property address and the offer price, again, customizing that pre-approval letter, and 60 minutes of time. We understand the need for speed, and we will get you that pre-approval on the fly so that your agent or yourself, whoever is submitting that offer to the seller, can get it done quickly and give you the best chance of getting your offer accepted. Here's an example of what that pre-approval letter will look like. Very professional. It will have my name or one of the analysts' name from my underwriting team and our contact information. Tell the seller to give us a call. Tell the listing agent to give us a call. We're more than happy to pick up the phone. Hey, are you working with so-and-so borrower? Absolutely. Have you looked at their information? Absolutely. They are good to go. We'll have no problem getting this loan done within the allotted period of time. Again, that goes a long way to getting your offer accepted. All right, moving along on our frequently asked. How does Marshall Reddick determine the rates and terms of the loan programs offered? Well, plain and simple, we made them up. Our programs do not change rapidly like conforming or government rates that are out there. They honestly haven't changed in the past decade, except for our recent rate drop that was applicable to our rental programs, right? And a lot of times these are just set on what is a really competitive private rate, because we want to attract the best of the best borrowers. And I think that our short-term or our bridge programs are very competitive in terms of interest rate, loan to value, so on and so forth. But they do require you have to bring some cash to the table, right? This is not a situation where you're going to be able to borrow 100% of everything and the lender is going to take 100% of the risk and you have no skin in the game and you can just walk away. But for those sophisticated folks, or for those folks looking to get started who have cash, our programs are extremely competitive. Here's a common one. Can I get a non-recourse loan as a non-retirement account, individual or entity borrower? We talked about that already earlier on. Unfortunately, you cannot. I'm happy to make a loan to an individual or corporation, LLC, or retirement account, but our non-recourse status is specifically reserved only when legally required, and that is in the event the borrower is a self-directed retirement account. Can I negotiate the terms of the loan? No. Sorry, but we have standard loan terms for a reason, right? I think that, again, they're competitive. So please do not try to negotiate the terms of the loan. I'm going to be less inclined to want to work with you on a future basis. And so in that case, I'll move on to the next man standing or the next man up or woman up so that we can continue the progress. Does Marshall Reddick service the loans that originates? No, it doesn't. And this is important to understand. Our rental programs are all boarded with a third-party loan servicer, right? We work with a couple of national servicers based here in California. They're not affiliates. They're just complete third parties, but you will have a legitimate loan servicer to whom you will make your payments. You can set up automatic payments. You can get year-end paperwork, so on and so forth. When it comes to our short-term loans, right, our renovation or our bridge or our new construction, the term is so short and there's really not a need for a third-party loan servicer. So in that case, Marshall Reddick will act as a customer service agent on your behalf, but we will not collect and remit payments. You will, as the borrower, remit your payments directly to the lender. Lastly, where does Marshall Reddick get the money to originate these loans, right? Well, we're not getting them from the bank, that's for sure, but we are a private lending institution. And so a lot of folks are curious where the loans, the money comes to originate these loans, and it comes from two places. It comes from our syndication, our Marshall Reddick Mortgage Fund, which is a 506 general solicitation debt fund. I have many capital partners in there who are investing in, what's called a hedge fund or a mutual fund, if you will. On the other hand, I have hundreds and hundreds of direct lending capital partners. And these are folks who are rental property owners and all types of investors, and they just like making first trust deed investments or buying notes or all those different things. So we allow individuals or small businesses to be direct lending partners of ours and fund the loans. So again, we come up with the money to originate the loans that we offer in two capacities. They're funded by our mortgage fund or they're funded by one of our direct lending partners. So know that when you as the borrower get your loan documentation, it's going to have any number of different lender listed but it makes no difference, right? The lenders can't negotiate the loan terms either. They are fixed and standard and set by Marshall Reddick and Marshall Reddick's guidelines. So lastly, I'm going to give you the contact information for my Newport Beach lending team. Very sophisticated, very experienced, all have trained under me for years. So in the event I am unavailable, I encourage you to reach out to one of my members of my team. They all understand everything that we went over. They're handling a large volume of loans, and they are able to help you on the fly if you cannot get me on the phone. So please do not hesitate to reach out to one of the Newport Beach lending team to get your questions answered. So again, thanks for your time. Again, my name is Patrick Prunty. As always, it was my pleasure to be with you, and I look forward to hearing from you and helping you obtain your real estate goals faster. Thanks. Have a great day.